All right, everybody, welcome back to the Sunday live stream for the Cashflow Chronicles, August 4th, 2024. Me and Mr. Patel had a quick phone call earlier, and we said, "What are you doing later?" And I said, "Nothing, because I have no friends." And he had just seemed like he just got back from getting some food with the missus. But he said, "Let's
I got
let's."
some I got some mango refresher bubble tea
There you go.
because today is going to be one of those nights, man. You
Yeah.
know, we're going to have to hold each other's hands and sing kumbaya for like at least maybe a week. Maybe less actually, maybe less. We'll see.
Yeah, so I mean, Chris and I were having a conversation. It's just like you're kind of in this territory where we've gotten into fear in the market, right? You guys know that gauge that
Mhm.
goes from like very fearful to like super greedy. We've obviously gone from one end of the spectrum past couple weeks to now the opposite side. But at the same time, it still feels like when this sort of happens, as we've seen in 2022 and we've seen in during the pandemic timeframe, this can go on longer than you would expect, right? Just like how you would see that that little pinpoint be directed in the greed section for weeks at a time. You could see the same exact thing in the opposite. So
Hmm.
we're sitting here, we made some moves in the portfolio last week, and we're sitting here being like, had it been a little bit too soon? What do we actually think? And then, I didn't see the futures open up because I was watching some TV, just got done making some dinner. And Chris is like, I don't know. So, Mr. Patel, what don't you know?
Okay, so we were pretty hedged with this current market. We had a bunch of TMF shares that we bought hoping to ride this volatility. But Friday, things just got ridiculous. The VIX had just absolutely spiked. So my thinking was, you know what? You kind of want to go a little bit against the grain. Usually, when VIX has gone like in super fear mode, that's usually a good sign that like the next step is going to be a little bit of a move to the other direction. It turns out this market is actually this downward move has some legs to it. So fear is contagious, and right now the Japanese Nikkei is taking an absolute beating. So a lot of people are selling over in Japan, and because of that, it's kind of like bleeding over into us a little bit, saying, okay, maybe we've got some sort of a massive correction on our hands. I am a little bit. I wouldn't say I'm I'm worried. That's probably not the right word. I'm right now just fishing for opportunities because I think usually markets like this are perfect for fear. I mean,
Mhm.
perfect for opportunities. When everyone is super fearful, that's when you kind of want to be a little bit greedy. So I figured Friday would be a good time to just start going on the opposite direction. So we ended up unloading our YCL position and our TMF position, and instead going into TQQQ. So the reason why is because we were expecting a recovery in tech with a lot of sympathetic buying on Monday. I think Buffett made it worse this weekend, though. Buffett came
I think
out
there's
and
two things, right? Or a multitude of things. There's the Buffett thing, which I'll let you explain.
yeah,
Japan being a little uneasy. You're also seeing some movement of troops to the Middle East this
mhm.
past weekend. So there's a lot of things. Sorry, I didn't mean to cut you off.
No, it's true. No, there's just a lot of instability and everything else in the markets, and basically, fear is contagious. It gets once it gets around, everyone just they panic sell, and a lot of people had made really good gains this year. So there might be a lot of people saying, you know what, let me lock in the profit while I can, especially if I want to keep my portfolio up for performance wise. The last thing you want to do is be up 40% for the year and then take a 20% drawdown and then report that as a thing. So some people are probably just selling and just, like, okay, let's wait, let's see what happens. I personally am there's really not much we can do as investors other than wait for this moment of consolidation. I think that if it does get any worse, the Fed will do an emergency rate cut, in which case that will be the beginning of the recession. And at that point, you just have to like look in the markets and say, okay, where are the opportunities to buy? And the best time to buy is usually during a recession when everything is sold off, in which case now you're getting heavy discounts on great companies. Like I'm looking at some companies that Like I was like, oh my God, I wish this company was at this price. I'd definitely buy it. But it doesn't happen that way. So
Yeah.
a lot of people, if you're looking at it year to date and your returns got absolutely destroyed, that's fine. It happens. It's one of those things that just, you have to just you just have to eat it. The good thing is making sure that you have dry powder a little bit on the side so that this way you can buy the opportunity in the market when everyone is selling, because that's what happens. This happened in 22 when people sold off a lot of the mega caps. I mean, it literally, Meta was down to $80 a share, which is
Yeah.
crazy if you think about it from an operating cash flows perspective. This time around, though, I think the market is overdoing it, especially because all the earnings from what I saw were actually pretty good, you
Mhm.
know. So I don't necessarily see this as a good. It's not the same as it was in 22 when we had all these SPACs going out of business and all this other stuff. Right now, most of the companies are healthy. There's a certain level of consumer that's, if you're above it, you're doing really well. If you're below it, you're probably not doing so well. Like if you have a 3% mortgage that's locked in, you're not getting pinched by inflation nearly as much as someone whose rent has gone up 20% over the last year and a half. Like,
Yeah.
so this is one of those times where you have to take all the data in holistically and just find out, like, okay, where do I want to be, and just and just chill.
Yeah, I think the thing that bothers me the most is, like you stated, Chris. I personally don't believe that will go down much further than this. Of course, there's a couple days, and that could eat into additional 5% profits for some folks, or just 5% of total stock price in general for certain companies, maybe even more, depending on what kind of company it is and how overvalued it is. But I was just writing and finishing up an article for Seeking Alpha on Google, and I had the opportunity to look at the Magnificent Seven, and I won't pull it up per se, but what was I looking at here? So I was looking at the trailing 12 months, basically of everything except for NVIDIA, because NVIDIA has yet to report. Everybody else has. And I'll just run through the price to earnings on a trailing month basis, right? So this,
Mhm.
this could mean that, if the things are going to continue to grow, which we've seen. Apple is the only one that really hasn't grown. It's really been Amazon, Microsoft, Nvidia, Alphabet, Meta, and maybe Tesla has also kind of rolled over in terms of growth. But all those other ones, you could probably expect the price to earnings to kind of come in better alignment than what I'm about to say. But really, Meta and Alphabet were the only ones that were kind of below 25x multiples. And
Mhm.
Chris and I actually talked about Amazon as well. Amazon's one where they invest a lot of money, so you kind of have to take depreciation into account. And in this one, they made $108 billion in cash flow from operations last trailing 12 months. So if you think about it, they're a $1.75 trillion company with $108 billion of free cash, not free cash, but cash flow coming into the business. That's a 17x cash flow. That's
Yeah.
pretty cheap. So other than that, Apple, trailing 12 month, 102 billion in net income. They're trading at a 33x multiple. Microsoft, $88 billion in net income and trailing 12 months. So their PE is essentially a 34. And Nvidia, like I said, yet to report for the second quarter, but trailing 12 months they were at 43 billion. That's a 62x trailing 12-month price to earnings ratio. Tesla, only $12 billion in trailing 12-month income. They had a 54x PE. So really the only ones that I see that are even fairly valued, Meta, Alphabet, cheaply valued might be Amazon if you want to evaluate it based off of the cash flow, but I could see that. But other than that, Apple, Microsoft, Nvidia, Tesla, they have room to come down, in my opinion. And so
Mhm.
when you get opportunities like this and the pendulum swings, the pendulum generally doesn't swing from exuberance to the middle of the road. The pendulum generally swings from, especially if you're going into kind of like a correction mode, from greed or super greed to super fearful cheap valuations. So if you think about it in that respect, you could see Meta below a 20x price to earnings, or Alphabet below a 20x price to earnings, Amazon dipping probably another 10-15% from here. It's possible, right? It's not to say like you're starting to see these things become fairly valued, but they're not cheap by any means, right? The only one that might be considered potentially cheap is Amazon, but it gives you a lot of opportunity.
Are we still holding DPST? Please tell me we actually sold it on Friday.
No, we did. Yeah, we sold it.
Oh, thank God, dude. I'm looking at DPST right now, bro. It's down 12% on the day. I mean, the banks are usually the ones that are impacted the most during recessions, because what happens is it's just we'll talk about the whole mechanism, but thank God we got out of that. I mean, I'm sure that we're probably not doing so well with TQQQ, but at least that one is only about 7% down right now. All right, whatever. Yeah,
it's tough. It's tough. It's a tough market. I mean, I think it's, you've been up so much from a year-to-date perspective.
Yeah,
You've been up, even the last trailing 12 months perspective, the last full year. On TQQQ, you're up 32%. On SPY, you're probably up just as much, 30-odd percent, 20%, 17%. Okay, so a little bit less, but
just do year to date. Year to date,
you're only at 11%. So, yeah, I mean, you have opportunity. I think a lot of people don't recognize this. People always assume it's like, oh, well, the market's supposed to go up 8 to 10% per year. It's like very rarely does the market actually go up 8 to 10%. It normally will go down 10 to 15%. It'll go up 10 to 15%. Some years it'll go up 30%. Some years it'll go nothing. So very rarely do you actually see it hang out in the 5 to 10% range. So it's likely either going to go up from here at 11% or go down from here. Very rarely does it end up being in the 5 to 10% range. So we'll see. I mean, look at what happened here, right? Everyone was losing their minds after 1Q. Everything was selling off, and you had an opportunity to buy really great companies. And I don't see at the moment a reason to, other than what you were going to mention, Chris, which you mentioned on the phone earlier, other than like these the Googles of the world, the Amazons of the world, they're still healthy. Their operating margins are healthy. They're doing really well. But Chris, you've alluded to this earlier on the phone. What isn't healthy? What is shaking? And what will potentially be that drag as we go into the second half of the year for the S&P?
Yeah, I think right now, first of all, tomorrow morning, please sell TQQQ. Get rid of that shit. Not because I don't believe that we could see a V-shaped recovery, but because it's just not prudent to be in a leveraged position without some sort of cover. I think one of the things that and this is something that we got a little bit greedy, and this is you have to be mindful and control your greed in situations like this. I think our biggest losers this year have been our triple leverage plays. You notice that? If we had just stick to regular stocks, we would have been a little bit better off. I mean, not to say that we didn't do well on our positions. It's just sometimes you're trying to do this directionality thing, and triple leverage never works as well as everyone thinks, and usually it ends up actually in failure. And I think that's a good demonstration of it. So tomorrow morning, make sure you clear that shit out. And we'll keep it. We'll keep majority of what we have in cash that we do sell with. The reason why is because opportunities will come, and when the opportunities come, we'll go hard. That's what you're supposed to do. The only thing is you have to be patient. You have to wait. So
yeah. I mean, for me, this is the thing. Is like I don't want to show bad behaviors, but of course, when you have your own private portfolio and it's your money, right? You can kind of do whatever you want, right? But the thing that I'm fearful of, Chris, and kind of slap me on the hand if I'm misspeaking here, is I want to show good behaviors in our portfolio. I don't want to show bad behaviors. And I would say, the things that we try to demonstrate, we don't try to say leveraged options. We don't try to do any of that stuff that a normal person can't do. We try to teach a little bit of macroeconomics. We try to teach how to value companies. We try to show when the things are starting to get a little boggy and what you can do to kind of manipulate or influence your portfolio in a certain way to manage that bogginess. The thing that I do, which I shouldn't, but I do anyway, because to me it's just like a small hedge in the upside way for the portfolio is I hold TQQ, and I have been holding TQQQ since 2021. And, but I'm okay dealing with that volatility because, it's me. It's for my performance over the next 10, 20 years, not to try to demonstrate, consistent, returns over the long term. So if it goes down 60% in a year like it did, actually it's probably more like 70 or 80% down in 2022, I'm okay with that. Because now I know I'm in the green right now in TQQQ, maybe not much longer, but I'm in the green for TQQQ, for a majority of the portfolio, and we'll continue to do. It'd be in TQQQ for the next 5 to 10 years, but I'm okay because I know it's not like it's 50% of my portfolio or anything of the like, right? I think it's like 6% of the portfolio, and that's because it's just grown so much. So anyway, what was it? What am I trying to say? But yeah, like I don't want to get people into bad habits, because what ends up happening a lot of times is Chris and I will be very prudent about, this time we made a mistake, but Chris and I are generally very prudent about ensuring we don't overload a position in the portfolio.
Yeah.
And a lot of times what I end up seeing people do is they do end up overloading their portfolios, and they end up getting themselves into trouble because they didn't truly think about the risks, or they followed somebody late, or they didn't want to do their own due diligence, or so anyway.
Yeah. So basically we'll sit on some cash. We'll wait for the macro to develop. I think the Fed comes in. What do you think? You think the Fed is going to come in and do an emergency rate cut?
I think that would be pretty scary if they did, because I think that would mean that they're focusing on the actual stock market performance data rather than the real data that's coming in from their normal,
Well, let me push back against that.
Yeah, for sure.
It's not like the unemployment. So the rise in unemployment has triggered the SOM rule, right? Or basically the leading indicator for recession. So the thing is, it's not the stock market. The stock market is just reacting to the news of the jobless number. They're not reacting to anything else. So they could come out and say, you know what, jobless numbers came in, and we've clearly got a slowdown. And so it's prudent that we do a 25 basis point cut. We'll be meeting in the FOMC next month, and we're gonna once again do another. We're likely to, see how much we need to support the economy to get our goal, which is full employment. So I don't necessarily think that. I mean, here's the thing: if they do an emergency 50-point rate cut, that'd be bad. If they just did like a 25% rate cut, a 25 basis point rate cut, it wouldn't be so bad. I think the markets would be okay with it. I think we'd get some normalization. I mean, the CME tool would go back to being normal again a little bit. And, let's see.
So how bad is this? Yeah, I put up a poll for anybody that's curious. Futures, CNN generally does some pretty good futures.
You want to know something shocking?
What's that, my
friend?
friend?
Now, the chances of a rate cut, a single rate cut, is only 27%. Double rate cut is 72%, according to the CME watch tool.
And this is for September, or this is for an emergency
September.
cut?
September.
So everyone's saying double rate cut now. Interesting. But yeah, just looking at this for everybody that's not really following. So we're down 0.8% on the Dow. S&P is down 1.5%. NASDAQ's down 2.5%. No bueno.
Yeah. I would say times like this, just close your portfolios. Don't look at it. It's not really much you can do anyway. Right now, the worst thing you could do is sell, because what you would be doing is selling into fear. Unless you have a position that you are absolutely not loving long term, you should sell. Also, if you have options that are expiring within probably a very short period of time, and they're already in the money, I would sell, because I don't want to be in a position where I am in an options position and I run out of time. Time is to me, when it comes to options, I only do leaps, and there's a reason why I only do leaps. And I'm glad I'm glad, like last week, I actually spoke to a bunch of people who were on the Patreon, and I told them, like, because they have Verizon and they have TFC spreads that are been maxed out. Like, dude, they're literally hit their short call position. So I told them, listen, do you have them for 25 or for 26? They're like, for 26. I said, all right, then cool. We golden, just leave them alone. And there was a reason for that. Time is on your side. You never want to hold these leveraged options positions into not financial advice, yeah, into expiration. I did make one really bad mistake though, and I'm gonna write a Patreon post about it. I was up significantly on Carnival and Norwegian because I had the spreads for them, and the RSI had gotten a little bit heavy. And I was like, you know what? Maybe I should downshift a little bit, take some profit, and put some capital to the side. This way, just in case there's something that's surprise that comes in, I'll have some capital to deploy. And I waited for Norwegian to do their report. And the report was great. Like, they absolutely killed it. Like, they did a beat and raise. The problem is the market did not recognize that, and then and then the next day just started with the selling, and I was like, all right, this shit is gonna suck. So at this point, all you can do is just chill, So
Yeah, I would say, yeah, I'm with you. I mean, don't be overreactive. I think it's a good opportunity to look at things that are in your portfolio, see if it's a good time to trim them, focus. And if you see something that is relatively flat so far over the past, say, 6 or 7 days, and, because my whole portfolio is down 7%, I'm down over six figures at this point. It's not a big deal, right? I was expecting it. But I mean, if you see something that you have an opportunity where you're like, hey, is actually doing relatively well, but it's kind of an auxiliary position, and you see something that you've been meaning to add to, and it's in a reasonable valuation place where you think it's a good time to add to it. The macroeconomics for that particular sector are okay. The company's still in good health, right? Because some companies aren't, right? Like, some companies are facing some headwinds with respect to consumer and things of the like. And so it could be a couple quarters before those get back on track. So
yeah,
if you do the due diligence and kind of understand where your company is going, where your stock is going, then it could just be a great opportunity for the market just handed to you to pick it up at a lower price. Like, if you're looking for Google over the next 10 years, I'm not saying run out and buy Google right here, but I mean, if it dropped to the 130, 145 range, I'd probably be looking, right?
Yeah. The regret for me isn't necessarily that I didn't sell at the top or anything like that. It's just I wish I had more capital to deploy. I have good amount of capital on the side, but it's not nearly enough to take an opportunity like this to the next level. If you're trying to really make some good returns, dude, this is the perfect opportunity to buy into this fear. But once again, you have to wait until the fear is over with, the consolidation is done. And you can never really say when that's going to be. All you can do is just I'm interpreting this from the sharpness of the correction. The sharper the correction, the more likely it is that there's going to be some policy intervention, and then you'll have like a slow grind higher. And eventually, if you look at, like, what they say, right? When in doubt, zoom out. So you look at the S&P 500, SP 500. All you have to do is just look at a year to this right here. Let me just pull it up. Okay, so let's do like a 5-year analysis, right? This is 2019. Everything is good. Everything is good. Oh my God, COVID. No, everything, sell everything. Everything, the world is over. Oh, okay, we're back again. Yay, let's have some fun. Yay, everything is good. What do you mean SPACs are complete garbage companies? What do you mean Google and Microsoft and Amazon, they're all overvalued? Here we go. And then we went down. And then everyone's like, wait a second. No, these companies are actually good. They're cutting employees. They're generating tons of cash flow. Buy. Let's go. And then back again. Like, and then inflation. Remember, everyone's like, oh, the Fed is going to cut. The Fed is going to cut. July comes in and oil prices go up. No, inflation is sticky. Oh no, what are we going to do until October? And then in October, inflation numbers come up better, and everyone's like, yay, everyone's happy, let's go, let's keep going.
Yeah.
And then in March again, the Fed is like, no, we're gonna wait and see, and it's down.
Yeah.
And it's back
Yeah.
up again and it's down. So it's just basically this roller coaster that we have to ride, and sometimes things get a little bumpy. The question is, are we going to see a small correction like we did, this time and this time and this time, or are we going to get a 21, like December of 2021, all the way down to like this? I personally don't see this scenario happening. I'm more of the camp that it's probably going to be just a couple of points here and there, policy intervention, and then we make the long higher. There's a reason for that, and I'll go over a lot of those things and some data points that I have. But the main reason why is because structurally there isn't that much of a problem in the market. The market's fine. It's pretty healthy, actually. Most companies' earnings are good. There isn't any like real credit risk that's out there, which tends to be the main trigger. You could say that there's an AI bubble, but the AI bubble is concentrated among maybe like some semiconductor names here and there, and nothing indicates that is like bursting other than the semiconductors getting sold off. So we'll see what happens.
Yeah,
what
I
about
think
the conflict? Yeah.
Sorry, yeah. Before the conflict in the Middle East, which I think is an important thing to discuss as well. I was talking to Chris earlier. I was like, I feel like if the consumer was really going to fall flat on their face, they would have already. And I think regardless of what you think, yes, I feel like everybody, especially in 2022, when the market was really starting to tighten towards the latter half of 22 and in the beginning of 23, I definitely like would wake up in the morning and kind of feel like stressed a little bit, but I got over it, right? Kind of since the past 18 months when we've really been flat at this 5% to 5.5% interest rate. Because you think about it, we've been at 5.5 for a year. We've been at over 5%, since 18 months from ago, right? So we've been here about a year and a half at this point, above 5%. If we were going to fall on our faces at this point, I feel like we would have. I think that the fact that it's taken us this long to start to see any sort of hurt in the market, I think it's pretty impressive. It shows the resiliency of the economy that we're in. Does it mean that it's perfect? Absolutely not, right? I think that there's been better economies out there, but I think at the end of the day, if we were to fall and flat at our face, I think we would have by now. And I think the fact that we're just starting to see little bits is positive. And so I agree with Chris. I mean, I don't think we're going to see some 25, 30% correction. I think we might see 10, 15%, which is normal, generally speaking, in a healthy market even. You'll see a 10% pullback. I just think that we've been so flush with capital, stimulus money on the side, that, in quantitative easing over the past 10 to 15 years, since really the great financial crisis, we're not used to seeing 10 to 15% pullbacks on a very regular basis. In fact, it's more rare. And so what we generally have seen is pullbacks of, say, 20%. They've been a lot more volatile because, some sort of emergency event sort of happens, or black swan event sort of happens. We've got to then kind of policy our way out of it. But in reality, in majority of the time, 10 to 15% pullbacks are very regular. They happen once a year, most of the time.
I think what it is just the sudden nature of the drop that's probably scaring the shit out of people.
I think so.
Yeah. The one thing I'm bringing this up because I just want to show some data points, and I posted on the group chat on our Discord. Basically, the number of unemployed people per person. Look at this. Right now, the labor market is still very, very tight. Over the last almost 20 years, right now we are at some of the lowest in terms of unemployment, with the number of job openings. There's a ton of job openings right now. I think it's about 0.8 per thing. So like, there are more jobs open right now than there are people. So that's number one. One data point to look at. Another one is this right here, which is household debt service payments as a percentage of disposable income. We're nowhere near 2008. We're nowhere near even 2000 or the 1990s. So the consumer, relatively speaking, in terms of personal income, they're not stretched. They're actually pretty healthy. Okay. Another quick data point to mention right here is the delinquency rate in credit cards. Yes, it's climbing, and it's kind of like flatlining a little bit here at the tail end because a lot of the stuff hasn't been updated really. But you can see it's still historically low. You know, it's not anywhere that's like completely crazy. It's just this is when it went down this way, this was because COVID stimulus helped a lot of people. And then a lot of people now, because of high inflation, they are relying on credit cards to basically make ends meet. And that usually ends up being on the more on the poorer side. I mean, I'm sorry to say this, but poor people, you give them the opportunity between eating and taking on credit card debt, they're going to take on credit card debt. That's just how it is. You know, if people can't make ends meet via their job, they're going to rely on credit. And so credit has been going up, and a lot of the borrowers at that income level, they typically, they'll get into more trouble in terms of delinquencies. So if you look at the delinquency on credit cards, it's really high. You know, it's going up, but I would say, it's still manageable. You know, and when you blend it all together, you can actually see as in terms of like total household with disposable income, it's here. And at the same time, the delinquency on credit cards is running a little hot, but it's still not like super bad. So I think if we didn't have a lot of these houses with people with low interest rates on their mortgages, I think we would have a much worse situation, especially if a lot of people had like floating rate debt. I think that could have impacted the consumer a lot more. But dude, most people are sitting on literally 30-year fixed below 4%, 3% mortgages, and they're doing just fine, you know. So was there another data point?
Yeah, I was
Yeah,
gonna
the other
say.
things, yeah.
Sorry, go ahead. No, you finish. You got the.
Yeah. This is the other thing that a lot of people were scared about, which is commercial real estate. Commercial real estate just kind of got blipped. It didn't even like register as being in a lot of default. I mean, a lot of it was kind of rigged because the banks just basically said, they just kind of pretended like people didn't default. But that's how the market operates, man. So
Yeah, and I think for the folks that are out there, I mean, it goes back to always this. This is more of like instead of a market thing, this is more of a life thing. I see so many people use money and just spend it so frivolously on silly things, and it goes back to me always just thinking about opportunity costs, right, and a cost benefit analysis and what makes you most happy. And to me, it's like, I feel like so many people are like, oh, I want to try jet skiing. So buy like a $3,000 jet ski and then they never use it. And, and then next thing you know, it's $3,000. They said that they go to sell it 5 years later, they sell it for $1,000. They lost $2,000 and they didn't actually do anything with it. I see so many people do that, especially my family and just in my peripheral friends that will buy things just for the sake of buying things for the short term because they're bored or what have you. Think about the things that really make you happy: family or vacation, or for me, it's the stock market. So majority of my money goes to the stock market. So I'm very biased here. But even if you think like what makes you happiest, if fishing is the thing that makes you happiest, like try to spend $5,000 a month in fishing. It's going to be very difficult. But I guarantee if you want to, you can spend $5,000 on a bunch of different other things. And money goes where attention goes. So if your attention's on everything else but your money, your money's going to leave your pocketbook and you won't even know where the hell it went. But if you're really focusing it on one or two things, saving, your family, and honestly, just like one hobby that really makes you the most happy, you're probably going to be happier. You're probably going to be wealthier, and you're probably going to have a better family life because you're definitely going to be concentrating more of your time on the things that actually matter. And so I just think that this is an American problem that we always have. But going towards like how I'm going to be taking a lot of this in, I'm already keeping my eye as a hawk on a lot of these mortgage rates. And I have a lot of excess cash kind of sitting in the background. Not a lot, but a significant amount of excess cash in the background. And so if I have the opportunity, I'm going to refinance some of these loans that I have. I bought 3 properties over the past 18 to 20 months, my personal residence being one. So, I mean, me being able to shave off even just 1.5% off of this bad boy is like $400-$500 a month. And that's not even accounting for the private mortgage insurance of another $70 a month. So if I were to able to, get to a place which I'm within striking distance, like half a percentage point of striking distance within some of these targets that I have, and it might be too early, but I'd rather get it locked in than not at all and save $500 a month than, wait to be like, oh, 4%, because to me, I'd rather be at 5.5% and pull that trigger and be at 5.5%, then wait for the perfect 4.5%, or wait for the FOMC to collapse and then go to zero interest rate again, which who knows if that's likely to happen. It never happens. And then I'm still stuck with, my 7% plus mortgage. And, to me, I'd rather just lock it in, get that additional $500, $600 a month in cash flow and just go, than really worry about, any of the other stuff. So that's how I'm kind of managing it. But at the same time, for my long-term portfolio, I'll probably continue to look at things to consolidate, things that I actually don't care about. Generally, what happens for me, and I've noticed this has been something I've noticed over the past 10 years for me, when the times are really good, I'll add up on auxiliary positions that I don't really give a flying F about, because everything's fat, dumb, and happy. The market's really good. And it's really these times where you get to look at things with a finer tooth comb and be like, why is that in my portfolio? Like, I bought it because, everything was going up and to the right. But in reality, now that things are a little challenged, is it time for me to take that and focus it elsewhere in the portfolio and reallocate that capital? And it could very well be that you just sit on cash as well. There's nothing wrong with that, especially in this environment where, most accounts are still yielding 4%. That's an okay thing as well, while you're trying to understand, where the waters are going to head towards over the next, say, 6 months to 12 months. But it's an interesting territory that we're in, because, I think everyone was expecting, just like me and Chris, the regionals and most banks to flourish with these rate cuts, because, the short-term sort of headwinds that they've had with the 1 to 2 year treasuries really putting a strangle on them, or kind of like an actual put, I guess, if you think about it, over the past 18 months. You'd assume, okay, well, some of that will be relieved as we cut rates over the coming year. But in reality, because of what we started to see with the consumer, everyone's kind of sitting there like, oh shit. But I assume that that's going to die down. I really don't think the consumer is hurting that badly. I think it's just a slight uptick that I think what's the word I'm looking for? The description, or maybe like the consensus maybe changed a little bit from, oh, everything's fine, to average. And I think that gets people scared, because you can go from average to poor pretty quickly. But I feel like we're going to navigate it okay. And I don't know what your thoughts are there, Mr. Patel.
So I'd say right now, a couple of things real quick. I'm looking at the Japanese yen right now, because right now I think some of this might actually is because of the policy move by the Bank of Japan. It looks like they're actually the yen's actually stabilizing. It's not that bad. The Nikkei starting to recover a little bit. So, let me just show this screen real quick. So this is not, hey, we're off the ledge by any means, but the market's going to do what the market does, and you've seen multiple drawdowns like this happen in the past. It's just a lot of people, they're looking at history, and usually when the yen, when something like this happens, it typically causes a lot of fear in the markets. Even like the Dow futures are starting to come up just a little bit, So let's see the S&P futures. Yeah, they're coming up a little. NASDAQ futures are they're still down. So right now, I bet this is what's going to happen. Yeah, tech is probably going to take the brunt of the hit when it comes to the sell-off. I don't know. It'll be interesting to see what comes about tomorrow.
Yeah,
I'm not worried about it.
As a previous military man, hopefully I don't strike up any previous flashbacks or anything like that. What do you think with what's going on in the Middle East right now? I'm fairly uneducated about it, to be honest. Other than I know that there's been some exchanges back and forth.
A lot of saber rattling. It's political, man. It's a lot of saber rattling. Like, Israel has to basically show everyone that they've got a big dick, and Iran has to show people that they have a big dick, and it's just like two dick showing contests happening right now. Yeah, everything's geopolitical and everything else too, but for the most part, neither one of them is going to attack each other, in my opinion, anyway.
You think it's going to be like a standoff as it has been for the thousands of years?
Pretty much. I think everyone's going to chant. Okay, so Israel, the U.S. is going to basically choke the leash a little bit and be like, back off. And then the Russians will do the same thing with the Iranians and say, hey, back off. And that's it. We're done.
Interesting.
It's funny, Reza Soleimani. He was the guy that the US what are they called? Drone striked. Or at least that was the name. I don't know if it's the same way to spell it, Islamic Republic does not have any dick. Okay, I guess. I don't know, man. I thoughts on escalation in the Middle East. Dude, how many times do we keep seeing these escalations in the Middle East? Like, really? It's like every other month you always hear this escalation in the Middle East. Like, bro, for the last, I would say 10 years, it's like, oh, Muammar Gaddafi, Syria, we bombed Syria. Oh no, there's war in the Middle East again, bro. I feel like Lockheed Martin has left more bombs. The only company right now that's probably up is Lockheed Martin. Let me see where LMT is right now.
LMT is it's one that I sold too early. I'll say that. Well, no, I don't know. I sold it too early. Although I don't know where it's at now, but it was doing really well. Since everything that's been going on over the last 2 years with Ukraine and Russia, so that's been doing pretty damn good. But well, I did want to take a quick spot out of the podcast to say that now that we're monetized, we've opened up memberships for the Cashflow Chronicles channel. So if any of you guys are on your desktops, you can look at right next to the chat box. There's a little money button. Don't feel obligated to, but if you do feel like becoming a member of the channel, we would really appreciate that for going forward. Chris and I are probably, depending on how large it gets, could end up doing some additional things that will be strictly for you guys. I know Chris does a phenomenal job already with his Patreon, so I'd be more than motivated to do things if the audience is there and warrants it. But just want to take a step out and mention that.
One thing, just to reward all the viewers who are on tonight, I will give you guys a play that I've pretty much been talking about on the Patreon, but I'll give it to you guys today because you're on here. So let me just share my screen. Well, let me go to it real quick. Yeah. Okay. So share screen. Okay. Brookfield Property Partners preferred shares. Okay. BPYPM. If anyone knows, I've been talking about this for the last, I don't know, probably like 6 to 9 months, but it's done extremely well year to date. I'm sure that there's people in the Patreon group, y'all can shout out your gains if you want to, but this is a great place to be, especially in markets like this. And I'll give you a couple of reasons why this is a great place to be. First of all, when you're dealing with preferred shares, they act more like bonds rather than equities, but the benefit is that there's actually liquidity, so you're able to buy these in the open market, right? So bonds, it's a little bit different. Like you have to go to your broker, and there is a platform on Fidelity where you can actually buy bonds online, but it's still it's a difficult process. With this, you can just go to it, buy, hit, sell, done. So it's somewhat liquid enough to actually get in. The other thing is this one is yielding almost like 12%. Well, not 12 anymore. It's probably yielding a lot less now. But basically, the terms of these deals are pretty much fixed, right? So you get these distributions on a quarterly basis. And you can see here, people got nice distributions, about 40 cents per quarter for the last couple of quarters that I've been talking about it. And they're going to pay you this, and this is a guaranteed payment. So it's not like they can just say, you know what, we're cutting our dividend. No, if they cut this distribution, it gets piled up cumulatively, and then they have to pay it to you before they pay up to the sponsor. But the reason why I really like this preferred equity position is twofold. And this is something that a lot of people weren't really taking a look at, but I'll show you. So if you look at, let me just bring up their last quarterly report. And this is a very, very simple thing, but I think it's important to mention it. So if you look at their revenues, right? They've got a lot of commercial property revenue. It's coming in, but look at this net loss. They lost $709 million last last quarter. So everyone is like, oh my God, this is a shitty place to be. I don't want to be here. Look at that expense, that interest rate expense, almost $1.2 billion in interest expenses. So they get revenue of about 2.3 and about 1.2 just goes right back into interest payments. So it's like, oh my God, why would I want to be in this preferred equity? Well, if you look here, let me just go to, 1 second. Right here, if you look at the variable rate right now, they have about half of the debt that they have on the balance sheet is pretty much variable rate. Now, what does this mean? This usually means that as interest rates, which are controlled by SOFR, as they go up, their debt servicing charges, their costs, they go up along with it. So if you look at it right now, it's costing them almost 8% on this $30 billion, which they're paying on a quarterly basis. So it ends up, causing a negative, what causes a net loss. But when you actually look at the cash flow, they're okay on the cash flow end, right? Now, here's the thing. Right now, we've acknowledged that, the Fed is going to be lowering interest rates, right? So what does this mean? That means that as the Fed lowers interest rates, this 8.2 goes in reverse, because now this becomes, next quarter becomes, let's say 7. The quarter after that, it becomes 6. The quarter after that becomes 5. The quarter after that becomes 4, right? That's how variable interest rates work. As interest rates go down, the SOFR goes down. That's for overnight funding. These guys end up making money. So now what happens is the net loss goes from net loss to net income. And because it's preferred equity trades more like a bond, where it's like the safer it is, the more it's likely to go to par. What's going to happen is this right here is going to go right back to being par again, which is at $25. And not to mention, the entire time you're holding this damn thing, you're going to be getting, about 40 cents per quarter. So, you add it up, it's like what, 10% return on a per year basis,
10 and
plus
a half,
the capital, plus the capital appreciation that you're going to get from this going back to the 25. So, it's actually just simple math. It's not super complicated. There's other parts to this also. I'm oversimplifying it, of course. There's actually some tax consequences too. So I'm not going to talk about too much of that. Do your own research. But these are the kinds of opportunities that are just hidden in the market, because not a lot of people know how preferred equities work, or they even search for them. They just look at the stock and they're like, oh my God, I want to be in a stock. Okay, be in the stock. Yeah. But if you look at it, if you got in when I was talking about this around $12, you're going to double up. $12.50 times 2 is 25, which is what it tops out at. 100% return plus the preferred the dividend, the distributions that you get. So
yeah. And here's an example of a real good success case that Chris had put together. Tellurian, which was one that was kind of nearing bankruptcy towards the end of last year, and everyone was kind of thinking, what's going to actually happen with this. But they just announced the buyout to Woodside, and with that, obviously that means that likely that these are going to go away 100%. So what ended up happening was, for those people that got into this in the Patreon, they were able to pick it up at 10, 12, sometimes even a little, $11 or whatever. And people kind of held on to it, right? And some people were able to sell it off at $25. In the meantime, they're picking up like a 15 to 16% dividend, because when they say 8.25, they're saying 8.25 on a $25 par value for the stock, or in this case, the preferred, debt offering. And, in this particular case, you're sitting there picking it up at $12.50, $12. You're doubling up your yield. So you're getting 16% yield. Next thing you know, they announce the buyout. Your preferreds go back up to par value, 23, 24, $25. You doubled your money. You got a yield the whole time. Not even just a small yield, but a 16% yield. You can find these if you just look up preferred shares on the market. Wells Fargo has some. Bank of America has some. They're not always, the greatest opportunities in the world. I'll just be honest with you. Some of them are really small utility companies that you probably want to stay away from. Some that are selling at like $2 to $3, but the par value is 25. Those obviously probably have a little bit more hair on them. but some
I
of them
will
might be
say
worth it.
this. Yeah. I always tell you right now, just try not to look for them without like really understanding how preferred equities work, how debt instruments work, how credit ratings work. Like all these things are very different. You know, Telz was much riskier play than BPUFPM. Absolutely. Literally Telz, the reason why we bought it when we did was one, for the yield, two, because we knew that someone would come in and buy these guys out because the value was there. You know, the market didn't see it. We did. You want to hear a really funny story? So someone who's on the Patreon, they bought Telz, right? And the Woodside announced the acquisitions. They were like, they messaged me, DM me, and they're like, oh my God, I lost all my money. I said, whoa, wait a second. What do you mean you lost all your money? What happened? He's like, well, you know, Woodside is buying them. Doesn't that mean that like all this money disappears? I said, no. It means Woodside is going to buy it out from you at full price, at par. I was like, how much of this shit? I was like, how much of this shit do you have? It's like, I've got like $3,000, $4,000. I was like, all right, $3,000, $4,000. You know, that's a good chunk of change. It's like, no. I have like 3,000 of these things. I was like, I had to like just be like, look, I have a lot of stuff that I say, and there's like conviction there, but dude, make sure you're position sizing based on the thing, because otherwise you're gonna be in a really bad place. So it's like it's just really funny to see that. You know? Yeah. But I'm glad. Like I said, there are a lot of opportunities in the market. Usually, times like this, dude, that's when you really want to look at preferred equity. Preferred equity is a great place to be. Even some bonds. Like I told you last time, we spoke about this, like Seadrill bonds, I think, and Transocean bonds. Neither one of them went bankrupt, and all the what is that thing called? All the bonds ended up going at par, man. Yeah, it's crazy. Yeah,
but yeah, it's you think about it. So just like in 2022, this exact opposite happened, right? Where you saw the 20-year Treasury yields go to the moon. And what that mean? It meant that the 20 years that were out selling at 2.5%, the value of those have to basically get cut pretty drastically to be able to keep up with the yields of the ones that were being distributed, you know, in the 4% range. So, you know, the exact opposite is going to happen, right? And I'm not saying run out and go and buy 20-year treasuries, because a lot of times you might be able to buy it from Treasury Direct, but there's no secondary market for you to take advantage of what I'm about to say. But if you have the opportunity to either potentially look into bond funds or something like that, just like the TMF trade that we were talking about, I mean, it could be an opportunity over, say, the next 6 months to a year, when these cuts actually do continue to come in, that will continue to persist. It's just right now things are a little waffly just based off of everything, but I think as we continue to go into the latter half of 24 and then in the beginning of 25, that trade will still persist and do really well. I don't know. It's hard to say, because it's like, you know, for a fact that if you had hundreds upon hundreds of thousands of dollars of 20-year treasuries, and they could sell it in a year's time on a secondary market, you would make a shit ton of money. But it's hard. You know, bonds are a lot more difficult of a space to be in, and liquidity of them is a lot more difficult than equities.
Yeah, man. I just think there's so many opportunities in this market that, you know, if we give it some time, they'll reveal themselves, and we just have to wait. And man, I'm looking at the market right now. There are some companies that are okay, they're recovering slightly, and then there are others that are just not
bueno.
And no, not bueno at all. Yeah. It is what it is. We'll see what happens, man. At the end of this week, we'll recalibrate everything. We'll find out what's going on. Oh shit. Damn. That's some nasty drops. It's getting worse.
Is it?
Like Royal Caribbean is down to Royal Caribbean's down to 130 right now. Norwegian just took a dive also a little bit. That's down 3.52%. So that's at 1537. Carnival is dipped and then it came back up. It's about down 60 cents. I'll be honest, the one that really intrigues me right now that's dipping this bad is Royal Caribbean. because they're actually pretty profitable. They're actually, if we just quit, let's just do a quick analysis on these two real quick.
On Royal Caribbean and because I never think we actually did.
Yeah, let me just do this real quick.
Yeah, let me see. Nvidia did dip below 100 just now.
Yeah. So Royal Caribbean's right here. If you just look at their PE, man, right now, Royal Caribbean's PE is roughly 12 right now in today's, well, before, maybe that's like it's probably a little less now. Let's see. But if you look at their financials since COVID, look at this. Revenue's been growing, and it's actually more than it was prior to the COVID drop. They didn't take on as much debt. Their interest expenses, they've been paying down the debt, and it's actually starting to like go in the other direction. So if you look at the balance sheet, because they generate so much damn cash flow, almost 4.6 billion in operating cash flow. They issued 11 billion in debt total. They repaid 10, so the net issued 8.4. But in terms of like a net, let me see how much they on a quarterly basis. Like, had some capex. Total debt repaid almost 1.8 billion. They issued 2.5 long term. I mean, look at their income, their EBITDA. Look on a 12-month trailing basis. Okay, look at this EBITDA number, man. They're generating way more EBITDA now than ever before. And this is not even the next season, which is their strongest season that's coming up. Let me just do some math real quick.
Looks usually like 35 to 40% more than the pandemic, pre-pandemic.
Usually the cruise lines trade at a 9 multiple on EBITDA. So it's 5.21 times 9, 46.89 billion in enterprise value, balance sheet. Let's look at their debt minus total debt, 21 billion minus 21.77. 25. So the market cap should be around 25 billion, close to it. It's about 35. That's a little overvalued. Well, I wouldn't say it's super overvalued, but the valuation could use a little bit of a dip. I think might have gotten a little ahead of itself. Actually, then again, if you give them a better valuation on a forward basis, because they are growing their top line a lot. Let's see, 19. I mean, they're not cruise lines. They typically trade, especially on a forward basis, at about a 14 PE today, which means about probably 10 or 12. So, I mean, yeah, I could see them being discounted. Am I going to buy this? Probably not. I think there's more opportunity in CCL. I mean, I'll show you guys what the opopportunity is. So if you go
I know you like the cruises, and I find
you want me to give you the thesis? I'll give it to you. It's very simple. Okay. First of all, their operating revenues have recovered nicely. Okay. Mm-hmm. So pre-pandemic.
I don't disagree.
Right. Their biggest challenge is this right here. Their interest expense went from 200 million to almost 1.9 billion right now per year on a trailing 12-month basis. Why? Because during COVID, they loaded the boat on a ton of debt. And then at the same time, if you look at their share count, right, on a diluted basis, you can see that they were buying back shares because they were actually doing great before the pandemic. They ended up taking on a lot of. They ended up having to issue a lot of shares to survive. So they actually almost doubled their total share count. So right now there's about 1.2 billion shares outstanding. So if you do that, of course, what's going to happen is the stock price is going to take an absolutely massive dive, right? And to survive, you're going to do whatever you have to. There's two main opportunities here. Okay, number one, if you look at their financials, majority of their problem is coming from right here, from their interest expense, right? if we go to CCL's debt stack, let me see, investor relations. Maybe I can find it because I was doing this.
I'm not saying you're wrong. It just, for me, I just wanted a few more quarters before, and maybe it means I would have missed the trade, right? But to me, it just seems
you got
like
a
they
second
haven't
shot
gotten.
at it.
What's that?
You got a second. So you got a second shot at it. You
Yeah.
know.
I mean, I think
But,
it's just an opportunity to wait a few quarters before you actually start seeing these things go in the right direction. They're flattening out, but you know, and I know that they're trying to purchase back some and reissue at cheaper, but it hasn't moved the dial enough yet where it would actually make me intrigued. And I think there's safer plays out there.
Well, I'll show you, right? So let's take a look at their debt schedule. So this is their debt schedule right now for them. So basically, if you look at their total debt is about $30 billion. Okay. This keeps a lot of investors away from this because they're like, man, $30 billion in debt and the market cap is 20 billion. You know, this is an indebted company. It's going to take them so many years to just pull, you know, get out of that. But there's two opportunities. Okay. So if you look at their debt stack, number one, you see this right here, this fixed amount, 7. This one is 4, which is okay. This is another one that's 7.8. So there's this right here is only 192 million. But if you look at this SOFR plus 2.7, SOFR right now is about 5.35%. So if you add 2.75 to that, it's going to give you roughly 8% on that debt. Same thing with this one. You add that together, it's going to give you 8%. So if you blend all of this together, you're going to get about, I'd say probably like 7.5, almost 8 as a total blended amount for this 5.8 billion. This 2 billion right now is running almost 10%, 10.38% in interest charges per year, right? You look at this stuff, a lot of this stuff is fixed, not really worth messing around with. Maybe this one is a little bit, but then there's another $1 billion sitting here that's about 10.5. The reason why I bring this up is because if you take all of this stuff in aggregate, it runs close to about 7.25, almost 750. You know, and so the cost of capital on this right here plus this, which is about half their debt. And of course, the Euribor is about running about the same as almost the same as SOFR, but it's only about 576. So you add all of this stuff together, you're basically going to get a blended rate of about 8% cost on capital, right? And so this is almost half the debt. So the other half of the debt is literally fixed and it's long-term debt. But look at the rates that they have them for: 3.2, 2.69, 2.69. This one is SOFR plus 1.2, which is good because that means that if interest rates go down, that one will recover. But most of this other stuff is really cheap debt. So half of their debt is expensive debt. The other half of their debt is super cheap debt. So if you combine it together, it looks like, oh my God, they've got a lot of debt on the balance sheet, and it's costing them almost $2 billion. The good thing is two things. Number one, the variable rate debt that's here, they can, as the Fed starts cutting interest rates, that variable interest rate debt, just like with BPYPM, gets lower and lower. So they have to pay out less, right? The other cool thing is, you see this 10.25, they can always refinance this. They can call these. And I looked at the call provisions on a lot of these higher interest, higher rate debt. They get called in 2025. So the company at its volition can go out and say, you know what, let's borrow from Peter to pay to Paul, but Paul is getting a 10.5% return right now. I'm going to buy his thing out and issue new debt for 5%, right? So if you think about the total cost of all of this stuff, it ends up being that right now they're paying $2 billion in interest charges. I did the calculations within like a year or two, and especially because they're cutting a lot of CapEx, they're going to be paying down a lot of that debt is going to go down to about 700 million. So there's going to be about 1.2 billion or 1.3 billion of cash flow that they're going to have going forward. And this is by 2026. So if you combine their income already plus the additional 1.3, it's a lot of good stuff happening. And they'll be able to delever really fast. And then eventually they could probably buy back some shares. And by then the market will recognize the value and then everything will go into the EPS. But the point is, when you do the analysis on the debt side, you can see that there's plenty of opportunity for these guys to basically refinance their high interest debt, turn it into lower interest debt. And especially with the CME group and the Fed right now, basically projecting out, let me just look at right here, the dot plot table, where was it? Chart. SOFR watch right here. You can see this one is there. Look at this. They actually changed the settings. They put 50 basis point cut in September and 50 in November. So that's almost a 1% rate cut. I actually had this at 50. I had this at 25. Block 25. And they had a pause in here. I'll probably put that as another 25. And September will be okay. So SOFR is going to go down from about 5.35 right now down to about 3.1. So if you think about that debt balance that we saw right now with SOFR being almost 8%, now if it goes down to 3.1, so by September of next year, that 8% debt is going to be like closer to 5. So that's 300 basis points of improvement. And when you take the total amount of debt that they have, it ends up being a big savings. On another thing is that they've actually committed to not doing a lot of new capex for 2025 and 2026. They don't have, I think they have maybe one ship in 2025 and 0 in 2026, which means all of that additional capex, and they're generating close to almost $4 billion in operating income per year right now. They could pay down $8 billion of debt. So, and most likely they're going to be paying down most of that high interest debt. So they can be very strategic with taking out that debt. And when they take that out, it's just money, you know. There's a lot of value there. So you have to really look through it. But yeah.
I mean, the theory makes sense. It just, to me, you know, will it actually, I don't know.
I'm betting on old people. I'm betting on boomers. Boomers love going on cruises. So my thing is there's more boomers going in retirement mode every day. There's an active audience that these guys cater to, so they'll be fine.
Yeah, I just often wonder, I'm just like, would I rather invest in like a CCL versus like a Amazon or a Google? And sometimes I get like, well, yes, there might be potential. I mean, based off what you're saying, if they're able to truly get to the bottom line and reduce their interest expense by $1 billion, well, then if you add $1 billion of net income and, you know, you then multiply that up by, you know, 6 or 7x for the price multiple, then, you know, you're going to add another 20 to 30% of the current stock price based off of that. But, you know, it's kind of like, yeah, I don't know.
So someone's asking, it's a very good question. Let me just put it up there. Someone said, are their revenues stable, right? So can you share my screen? If you look at it on a TTM basis, look at this. From 2014, seems pretty stable. You know? Seems pretty stable. So I wouldn't worry about, there's not a lot of growth. And the thing is, there was a reason why there's not a lot of growth is because number one, in order to grow, you need to add a lot more physical hardware, which is you need to add more ships, right? They've added plenty of ships during COVID because usually you have to order them at ahead of time. And this is one of the reasons why their balance sheet got wrecked, because they had to take delivery of a lot of ships during a time when the whole market was closed. But once again, this is like a giant recovery play. The revenues have recovered. Their operating incomes, you know, for the most part is recovered. So I wouldn't worry. I mean, I would worry. What am I saying? But yeah, they're getting back to normal again. If you look at this in 2026, you'll be like, wow, this was actually a missed opportunity. The other thing is if you look at this on a growth basis on EPS, They're going to be growing their EPS about 30% next year, 16% the year after that, 11 and 21 compound. I don't necessarily trust a lot of these numbers. I did my own math, and I think it's actually going to be a lot better than this. I do trust the numbers that are for Norwegian, which are this right here. You're looking at a 30% compounded growth rate for 2025 and 2026. So, yeah.
Interesting.
Yeah, no, once you do the math, you'll get it.
No, I see the math. It makes me wonder, like, is it really that better of an investment than Google, or Amazon? And I just don't.
Here's a question. Right now, Google is worth what? 2.4 trillion, 2.5. Is it going to be a $5 trillion company? When is it going to be a $5 trillion? How much would they?
I think it'll be a $5 trillion company way faster than you think.
You think so?
I think so.
We'll see. We'll see.
I mean, I was just doing the math today. I mean, I think right now the cloud business is at a $4 billion run rate. In not too distant future, it'll be producing about $150 billion in revenue, and that'll be a $30 to $45 billion a year net income business by 2030. And if you just add that sort of valuation onto Google as a whole, if you multiply that by 25x, I mean, you're talking about close to $1 trillion business on its own. Just like Amazon, right? I mean, it's about where Amazon and them are, a little bit further than where they are today. But I mean, they're solidly number 3. Growth rates for cloud has continued to maintain 20%. So, I mean, it's just not a time to really, I'm not saying you are betting against Google. It's not a time to put your foot off the gas just yet, unless something really comes in. And to me, while CCL could be a good opportunity, I'd rather wait for a better entry point personally.
Yeah. Someone is asking about Ameriprise Financial. Let's take a look. Okay, so Ameriprise Financial, look at their SEC filing. So first of all, what do they do? Like, I always have to look at what they do. If I don't like what they do, I just stop right there. Like, so some people are asking me, by the way, like, how do you find these companies, Chris? Like, what do you look at? And the first thing I say is like, okay, let me look at what this company actually does. If I can't understand what the company does, it's like dead on the water for me right there. Like, I don't know, let me just go to there.
I think it's more insurance, isn't it? Sounds like insurance.
Is it insurance?
We'll see.
Distribution. Oh God. Nah, man, I ain't trying to analyze no finance company not right now. Finance companies are very, very hard to really do like a good deep dive and analysis into everything, because there's like so many things that they can kind of just like hide. So like as an example, it's man, it's like there's like too much. I'll take a look one of these days if I get a chance. But asset retail, yeah, I don't know what they do. So let me like stop right here. It's just, yeah, it would take a lot longer to analyze than try to just do it live. So
yeah, I do have a question for you. What do you think will happen with your nemesis company, Palantir, tomorrow?
They're gonna get killed and they're gonna dump. It's gonna go below 20, and then I'm gonna laugh and I'm gonna enjoy, and I'm just kidding. I have no clue, man. I really don't. They might do well, they might not do well. I don't know.
Okay. Yeah, I was just curious because I mean, everyone always asks when we do these, like, because as you know, with these Palantir weeklies, a lot of it becomes hopium, and I try to provide like a slight back to reality sort of thing. People are like, oh, it's going to grow at 35%. And I'm like, I don't know what you're smoking, man. Like, I love the company. I hold the company. I have 4,500 shares, but 35% year over year, like where, right? Like, I just, you know what I mean? Like, It's overvalued, right? Like, let's just be
Matt,
frank, right? Like,
just sell your Palantir, buy some Carnival cruise lines, man. They're undervalued. Come on. That's what you got to do, bro. Join me in the cruise lines. That's where the money is, you know.
nah, I'll buy the cruise line when you buy Rocket Lab. How about that?
I'll do that. I'll put $1,000 in Rocket Lab. You buy 1,000 in cruise line. Let's see who does better.
Oh,
are
we gonna do are we gonna do the 5-year, what is it, 2-year challenge like
Yeah.
you did with Adam? How about that?
Yeah. 2.5 year. Let's do end of 2026.
End of 26.
Yeah. I'll deposit 1,000 right now. I'll buy Rocket Lab. There might be something there. There's a lot of interest in space.
Wait, so who wins? If Rocket Lab does better than the cruise lines, I win, right?
Yeah. Yeah. And if cruise lines do better, then I win, right?
So how does this work? Hold on. Because you guys bet what, what'd you guys do? $1,000 and whoever won?
$1,000. Whichever one did year to date, whichever ones like do better based on just overall performance from the date that we agreed upon. That's it. You know.
Okay. And so do we have to buy $1,000 worth, or is it just tracking it?
No, just tracking it.
Okay. So as of when? Today?
Let's do next week. Probably not this week.
I think waiting a week will probably only help me.
Yeah. Okay, we'll see. Actually, it would help me, dude. I want this shit to go as low as possible. This way, the recovery is the strongest. Come on, Matt.
Carnival.
So right here, someone says yes, because if we go into recession, consumer spending is definitely going into cruises. Yeah, man. Yeah, that's what's gonna happen. Everyone's gonna go on cruises. What do you think?
I don't know. What I'm thinking is I need to book my vacation for the end of the month to Mexico because I'm getting cabin fever hanging out in this house too much. But I'm being spoiled. I shouldn't talk about it because I mean I'm fortunate to be able to go on a nice vacation, and I shouldn't throw that in people's faces. So it'll be nice to get out of the house.
Yeah.
Then.
So I'm glad that Charles Stewart said retirees are usually recession proof. That's absolutely right. So if you've ever been on a cruise, the one thing you'll notice is that it's mostly old people. Like it's like 60% old people. And what I mean, like it's like above 50s into the 60s, they're retirees. You know, they've got plenty of time on their hands and they love. Have you been on a cruise yet, Matt?
No, I want to.
See, this is why we need to plan a cruise out. And now there's actually a tons of that leave. Like, how far are you from Galveston?
Not far. It's like a very short drive. Very short.
Okay, we are going to go on a cruise. I am going to turn you into a believer. I'm telling you, if you see the amount of craziness that happens with cruise ships, like everything is there for you. It's amazing. Well, you know what? We'll plan it out. We'll go for a week.
Is it better than like an all-inclusive? Like, because like I said, I don't want to bring it back to my crazy fancy all-inclusives, but like, okay, so you spend $250 a night, all you can eat, you can get a drink package. It's just like an all-inclusive kind of, but I mean, is it as nice as an all-inclusive or not really?
It's even better.
Why?
So 3 things. Number 1, you have ports of call that you can go to with a regular airline and stuff like that. You have to plan everything out. You have to literally fly, you know, you go to like, let's say you want to go on a European like tour, right? You actually have to go there. You have to find your own hotel. You have to find your own food. You have to do this. You have to do that. With cruise lines, you get on a boat. There's already activities on the boat for you to do, like tons of activities. Okay. There's like even movie theaters on there. So you can watch a movie if you want. If you want to go on a pool day, you can go on a pool. If you want to go get a drink at the bar, there's tons of bars on there. There's casinos on this thing. So if you want to just go gambling for a little bit, you can go gamble a little bit. Right.
Not good. It's not good for Maddie's wallet. Maddie's not.
And then the next day you wake up, you're at your destination. You're in Jamaica, you're in Mexico, whatever. You go, you do an excursion, a shore excursion, right? You have a great time. In the afternoon, you come back. And at night, you go to dinner with your friends and family. It's awesome, dude. And It's Heinze says it the best. He's like, it's like a floating kingdom with servants. There's some cruises where there's one servant per guest. That is absolutely true. It really is like that. Matt, I'm going to take you on a cruise and you are going to love it so much. You will never want to not be like, trust me, once you get on a cruise, it's addictive. Okay. It's amazing. Everyone loves it, you know? So yeah.
I don't know. I hear 50-50. That's a lie. I don't hear 50-50. I've heard some people that are cruise people, they like it. I hear some people that are not, but
you know. Dude, it's a floating Vegas. That's right. We gotta go, Matt. We're gonna do it.
You mentioned the gambling part, and the gambling part's what scares me because
you don't have to go gamble. You don't have to go gamble.
But that's the thing. If there's an opportunity, I will. No, I'm just kidding.
Don't be a degenerate.
I'll drop $3,000. Like it's nothing.
It's like wake up in the morning and I'm like, where the hell is Matt? It's like, oh, and by the way, some of the cruise lines, they have their own private islands that have like crazy things you can do there. You know, dude, it is an amazing experience. You got to go on a cruise, man. Just went on a 7-day cruise. They were so full. They were overbooked. Just came back from the Western Caribbean. Loved it. Absolutely, dude. Absolutely. And what's cool is that now they've got Starlink, which is like high-speed internet. One of the chief complaints that I had in the past about going on a cruise was that I'd be disconnected from like, you know, the rest of the world while I was on there. Bro, with the new Starlink thing, it's amazing. You could be on your phone. You could do whatever. I used to work on a cruise ship for 2 years. Absolutely. It's great. You'll love it. You'll love it, Matt. We got to go. We'll go on a Carnival cruise trip too, you know.
Why Carnival versus like Norwegian or Royal Caribbean?
All right. So even among the cruise lines, there's like a level of degeneracy that comes with it. Okay. Carnival is like,
I just want you to explain it.
Carnival is the most degenerate, right? Like but it's fun. It's fun degeneracy. Okay. Royal Caribbean's like somewhere in the middle. Like it's actually kind of fun. Royal Caribbean has the biggest ships in the ocean, you know, like these are just amazing ships. Like they've got so many things to do. And then the last one, of course, is Norwegian, which caters to like the more premium type people. But then there's other cruise lines also that are like sub like categories as well. Like they're really good too. Like the one that I would recommend as your first cruise trip or our first cruise trip, we'll take you to Royal Caribbean. We'll use like Icon of the Seas or something because I haven't seen that goddamn thing. It's beautiful. Let me pull up what it looks like. So
this is true. We should get like an Expedia link and just post it in. I actually thought about doing this because I do travel enough now where I'm like,
yeah,
couldn't I make a business and like videotape it and then put like Expedia links and stuff, like kind of like how people do that for stocks or Amazon or something like that. I should do that. And I've thought about actually making a Matt Travels channel just for that. And it'll be a losing money venture because obviously I wouldn't make enough. But
look at the size of this thing, man.
Today we've got our first look at Royal Caribbean.
It's got water slides. Like just take 2 seconds. It's water slides on a freaking ship.
It's brand new cruise ship. Here we go. Perfect day at Coco Key. Now the ship will be delivered at the end of 2023. Sometime between.
If you want to play some basketball, they've got basketball courts up there. You know, I'm gonna keep going. I'm sorry.
End of October, early November. But because it's the first ship in the new class, they're gonna need time for extra testing and adjusting, so that way it can be ready to enter service. So that is why the first sailing is not until January of 2024. Now, you may have heard about plans earlier that Royal Caribbean was thinking about offering some sailings from the UK.
This is boring. I want to see some like just real stuff, bro. Hold on. Let me go to Royal Caribbean. Hold on. Royal Caribbean cruise. I just want to show you what it looks like. I don't want to. Okay, hold on. Here you go. This is the new one that's coming out. It's called Star of the Seas. It's another one it's not good. Let me see.
Oh, there's a $600 sale.
Where?
Royal Caribbean right now.
There is? All right. Wonder of the Seas. Let me see.
Welcome to the
Where's my
Wonder
port?
of the Seas.
Yeah, I mean, look at this. This is the kinds of stuff that they have, man.
It's a really comfortable.
It's awesome.
We're gonna go up a deck. Let's take a look at.
They have like different places where you
Let's
can
head
get
on
food.
down to the Royal Promenade. I'm gonna
Yeah,
give you a
like
preview.
this.
This is Spotlight. Right after that is Sorrento's and the English Pub.
All right, I'm not gonna lie, that
Promenade,
looks pretty dope.
and the Rising Tide Bar, the Bionic Bar. Let's head up a deck. Over here is
How much are the drink
Cedar Bar.
packages?
Out here is the
I don't know. I gotta look it up. But Matt, we gotta go. All right.
Which
When
one
are
did
you
you go
free?
on? Mariner of the Seas? Which one were you on?
I don't remember because the wife does all the planning, but we were in Royal Caribbean when we went. I haven't been on a Carnival ship, but I hear it's actually fun. And there's like a lot of subcategories under there also. But let me know when you're free because now we have to go on a Royal Caribbean trip.
I'm going to an undisclosed European location for work at the end of September. I have to come home, renew my passport, and then anytime after that. So I guess sometime after October,
Okay.
I would be ready to
Any
go.
preference? Mexico, we could go in the Caribbean. Caribbean is the best place. But there's also, they have cruises to Alaska and they have cruises to Hawaii and to Tahiti now, to Japan. If you want to do a transatlantic cruise, you can go to Europe on a cruise trip. You know, I wouldn't recommend it though as a first-time cruiser. I think 2 days, 3 days is enough. Yeah.
Yeah. Oh, just 2 days, you think? Your 4-day night, whatever it is?
Yeah. That's enough. I mean, it's your first time, bro. I don't want to be the guy that's like, you know, you go on the ship and you hate it and you're like, man, Chris is signing me up for like a 7-day like nightmare. So yeah.
I don't know. That's the thing, is it's like I feel like I would want to do, if I were to go to places, I want to go places I've never been. Like this is talking about Honduras. That would be pretty dope.
Honduras. Man, you trying to go to third world? Why?
I lived in the third world, man. Don't be hating on the third world. I love the third world.
Yeah, all right.
I miss Trinidad. Trinidad is a great place. I need to go back. This has got the Bahamas. I've never been to the Bahamas. I don't know. I gotta everywhere it's like either like Bahamas or Mexico, and it doesn't really like go in between. And I'm trying to get involved. Like I'm trying to go to some crazy ass places in between. Maybe it's because I think what it is because I'm leaving out of Galveston, and that's what it is. Because Galveston's already so far west. So I feel like I would need to go to Miami.
Yeah, if you go to like Florida has a ton of places that they leave out of. So
yeah, let me see.
Where are you looking?
I'm just on RoyalCaribbean.com.
Okay, yeah.
I'm sure if I leave out of Miami, it gets a lot of. Yeah, this is like St. Kitts, Bahamas, St. Thomas, some wild places. It's also more expensive. It's like 12. Oh, this is Icon of the Seas. This is a $13,000 boy. But for 7 nights, you're talking less than $200 a day.
Yeah, you have to look
at.
Like,
does that include drinking or what? I mean, I drink like a fish, so
I don't know, man. We'll figure all this stuff out. But basically, it'll be a nice little discover cruises. Aruba, Curacao, the best destinations. Okay, I'm down. Bali has great waves. Miami. Yeah, man, a cruise ship. We got to get on the cruise. You got to learn. If you are a stockholder, $99 a day drink package. Okay, yeah,
$99. That's not bad.
Man, I don't know about you. I'm cheap as shit. I'm not buying no $99. You can sneak.
You got that money. Don't do that.
I know I have the money, but I'm cheap. That's why I have the money. You know,
go buy another hotel, Chris.
I'm not one of those hotels.
I know. Just fucking. That was bad. That was a mean joke. I apologize.
That was racist. That was racist. Damn white man telling me to buy a hotel. I'm not gonna buy a hotel.
But yeah, I'm excited, man. It'll be an interesting week for sure. I'm gonna be chatting on Palantir's earning report.
I'm a gas station Patel and proud. All right.
Are you?
So,
oh, well, you go.
Get it right. Get it right. Gas station and liquor stores.
Rocket Lab will be live. So for those of you that are interested, I might try to do Black Sky as well in the morning. Dutch Bros is in on Wednesday as well. And then for me, we have Peter Beck interview on Friday night. So when we actually put that live on Vince's channel, I'm not 100% sure, probably Saturday maybe, but that'll be fun between getting and looking at the earnings report and then turning around, getting all our questions verified and agreed upon by investor relations to be able to have that interview. That'll be a lot of fun. But Mr. Patel, you gonna do any live streams with Hot Sand this week, or?
I'll let y'all know. Maybe
Mm-hmm.
maybe later this week, actually.
Yeah.
Yeah, I just got to coordinate some time with Sam and see if he's free, and
All right.
we'll get it done. Yeah.
And I want to shout out to the 3 members that joined today: Silly Bont, Kinch, and Fool's Gold. Fool's Gold, as always, you're a great supporter. We're trying to get Chris on the Rocket Lab train, my guy. We're trying. We'll get him there. But yeah, as always, I really appreciate you guys. It's always fun to catch up. Appreciate Chris having the impromptu session today. Mr. Patel, is there anything you want to sign off with?
Buy cruise lines. Let's go. I'm telling you, these cruise lines are gonna 4x on you, bro. Cruise lines is where you want to be. I know it sounds stupid.
Okay, if it's gonna 4, then I'll dive deeper. I'll dive way deeper. If you think, honestly, within the next
long term cruise lines are a great place to be.
Long term meaning 2030 or
2030, whatever. Just they're good. They're really good. I mean, the business model is very profitable, especially because like there's a lot of moats around cruises that people don't necessarily realize. You can't just get in and start like doing your own thing. It's really good. Yeah.
Anything on ATKR? I have a buddy who also is an ATKR, and I haven't done any due diligence on it, but I know it's retraced in price quite a bit. I don't know.
Maybe we'll save that for another episode. They definitely are one of the, in my opinion, one of the better small caps to be in. And I can discuss why. They have taken a bit of a beating lately, but dude, this is a small cap that's about $4 billion. Let me just show you guys share screen. About $4 billion. It's actually generating net income, right? So it will recover.
Cheaply traded too. Like the price to earnings like 7.5.
Yeah. Yep. So if you look at this, their net income has come down significantly from 2021 highs. Majority of that is because they had some changes in some of the products that they sell, right? They got really good pricing around here that now they don't have a lot of great pricing on, so they've come down a little bit. But what's good is that on a cash flow basis, they're generating almost 649 million in operating cash flow, which is coming down. But at the same time, they've been repurchasing a ton of shares, right? So if you look at this on a PE basis and you just do a long-term calculation, you can see that there's actually value there. So if you forecast it out, they've actually got a lot of upside. They're going to have a couple of transitional years where it's not going to be as good. But if you look at like earnings per share, that's like forwarded out into 2025 and 2026, 2024 is going to be about 16, 18, and 19. So it's going to be 7, 6, and 6 PE.
Oh wow.
Yeah.
I'm just looking at the street on like Wall Street analysts 1 year out on Atcore, and their range is really narrow. Surprisingly enough, let's just see how many people are actually following it. 6 analysts in the last 90 days from Wall Street. And they're giving it, this is from Seeking Alpha here. So this is Seeking Alpha Premium. I just had this up because I was finishing up an article for Google. But you can see the average price target 1 year out, $180, 47% upside from here it is today. And their range is really narrow, 160 to 200. Let's see. Everybody rates it at least as a hold or a strong buy at this point.
Yeah.
And it looks like nobody's really wavered too much. Everyone's kind of had it as a buy for the past 2 years or so. Curious to see what the rest of our Seeking Alpha friends say.
So this is what they do basically, and this is like a boring company, but I like boring companies. I'm all about that, especially cruise lines. You can see their adjusted EBITDA margins have kind of come down a little bit from 2022 when there was just this huge amount of demand to build for building, and so they were able to charge premium prices. But you can see long term they're fine and they're a profitable company. So over time, their net sales have gone from about 1.5 billion to right now about 3.5. They have taken a bit of a nosedive. What's that thing called with demand, but it's still there. Adjusted EBITDA, debt to adjusted EBITDA is actually
Right.
down significantly, which means that they're not over levered by by any means. Adjusted EPS is actually pretty high too. Yeah.
Interesting.
The play on this was that you would see a lot more like data center build outs, and these guys provide a lot of the like the materials for these data centers, but definitely check it out, man. So
Yeah, it's
actual
definitely been
book-
one that looks like it's doing relatively well. Other than maybe the shrinking net income, that's something I would potentially look at. But
yeah.
interesting.
Yeah, it's just you really have to go through it and just double check on that. But it's essentially their goal for 2025 is about $18 a share, which if you really take a look at it, it's not that bad. And I think they even issue a dividend now. They started a dividend.
Yeah,
So net income.
small dividend.
Yeah. But they'll grow that dividend over time. So definitely do your due diligence on this company and check it out and see where things go.
Yeah, there's a lot of great companies out there, man, that I think just print money, and I think a lot of them have been overshadowed on the small cap side because of the environment that we're in. And I think you're going to see a lot of these kind of come out of the woodwork. Like people are like, "Oh my God, what about X, Y, and Z company?" And at the end of the day, you're going to realize that it's been a phenomenal company. It's just been in the wrong sector, and unfortunately, isn't big enough to get the highlight of the S&P 500. And so. It'll be interesting. There's a few that I know about that I'll probably talk to you about, but
Yeah.
it might be a different story for.
Did you gift 5 memberships? Did you?
Yes. Yeah.
Oh, nice. Thank
Yeah.
you.
Yeah.
You're donating to the growth fund. Nice. Okay.
Yeah. Basically, yeah. I mean, it's just the growth fund, pretty much. So all that money goes
right.
right
Do you want
back into the.
Do you want to do a quick portfolio update on what we have?
Sure, yeah, because we did do some wild changes, some seesawing. Whether or not it's going to look like this, whenever we meet up next time, different potentially. But this is where we're at. Let me put it into slideshow mode. So we took a little bit of a tumble, 2% down on Friday alone.
Look at that pain.
Pain. So 4120 is where we're at for the portfolio. So this is after adding, I think it was about another 1,000. And now that we're monetized, it'll be nice when we get back up to making $100 or so a month. Hopefully, in income from this, we'll be able to grow this. And our goal in the medium term is getting to 100,000 for us. So hopefully we'll get there within sooner rather than later. But you can see we moved a lot. This is currently sitting on value being at the peak, and then the least valuable positions being at the bottom. You can see that we added a lot of TQQQ, as Chris alluded to. We sold out of TMF. We sold out of YCL. We put some money into BPYPN. So that beefed up to about 17% of the portfolio, BPYPM being about 15%. Carnival Cruise is hanging out at about 9%. Norwegian hanging out at about 8.5%. But those are negative as well at the moment. Next Decade hanging in there at about 4.5%. Rocket Lab still hanging out positive. That'll actually, we got a pretty good price, but who knows? It might go negative depending on what happens this week. ASTS, I was actually going to question: do we want to hold on to this, or do we want to?
Nah, we could dump it. That was just a fun
Yeah, we were up at like 5% at one point, but I think we got in too late for that one.
Yeah.
HIMS, I think that's an okay to hold. Bitcoin's going to look very bad tomorrow, but luckily it's only 1% of the portfolio. So we'll probably keep it at about 1 to 2% of the portfolio if it was up to me. Celsius is about $41. This is looking pretty poor in the pre-market as well. And ABCL, who knows what the heck is going on with this one? Hopefully,
ABCL just signed a deal with Eli Lilly.
Did they? I thought I saw something. Yeah. I wasn't too sure.
Yeah.
But other than that, it'll look good. I think where we're at, we're still way outperforming the.
Bro, that TQQ, that's the only one that's going to hurt tomorrow. The rest are fine. The rest will recover. The problem is with TQQ, like if they go down too much, the recovery is going to be even harder. So
that is the hard part, and especially when you have consecutive days, right? That's what makes it really tough, because when you think about it, and you'll never go like, say, a lot of people always think like, oh, well, you just get 30% down, you're going to wipe yourself out. It never gets like that because it resets at the end of the day. So it's always 3% on the new value of the stock. So, you can have pretty rough down days. If you go down 30%, in the matter of a couple months, like we saw in 2022, you do see 70 to 80% pullback. And I've lived that, and that's pretty tough. But it gets now to the place where, when we were at the peak, just a month or two ago, you were at, mid 80s on TQQQ, going to the 90s on TQQQ. And really just when you have so many consecutive up days, it starts getting really crazy really quick, because it went from like $60 and hanging out at $60 to $90 within the matter of a couple weeks.
I got an idea. Sell about 90% of it. Keep like one that you had before. Just keep one. The rest just done.
It's done.
Yeah, the rest we can sell just because we're overexposed to it. If we weren't overexposed to it, it wouldn't even be an issue. But this is about portfolio and risk management, right? So we just gotta be a little bit. Aldi has bent the knee to Celsius. Saw some stacks there yesterday.
Oh,
okay. Yeah, interesting.
Yeah, I'm curious. Celsius reports on Tuesday, so we'll see what ends up happening with that. And to me, I think that this is appropriate range for Celsius here. If they have a sufficient earnings, if they have abysmal earnings, then obviously the bottom's out, and it'll probably go into the low 30s. But I think 42 in a good market would be a good place where I would start loading up. I was expecting it to kind of turn around at the 45 range, and I'm not sure if it's just getting caught up and the rest of what's going on in the market, but we'll see on Tuesday.
By the way, just one last thing about Carnival before I stop. They're actually pretty good post recessions. Like if you look at the stock, like great financial crisis hits, they go down right here from 37 down to like 23 to 18, and then literally shoots right back up to like in a couple of years, and then it comes back down a little bit, but then it comes back up. I'm telling you, this is a good place to be, man. This overall, it's not gonna be like a up into the right linear move upwards, but I think there's tremendous amount of value going forward, especially as the infrastructure is all there, all the ships are there, all the investments are there. This is just a recovery of demand. That's it. So you've got a strong business. So all the capital that was generated for the last 25 years, whatever, and now you're getting it to buy it at a discount. So yeah. Carnival, join me. Join the dark side. Yep. All right. Have a good one, man.
You guys rock. I'll talk to you guys on the next stream.
Bye.
Cheers.
Oh, play our song. Or play our little.
Greed is good.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good. Huge upside potential, upwards of $60,000.